On April 2016, Copen purchases a machine. In this unit, we are going to analyze and post that transaction. But prior to that, let's go over the previous unit. It addressed the analysis and accounting for the transaction related to the loan that Copen took out on March 31st, 2016. Regarding cash flow, that's to say collections and payments, in 2016, Copen collected the principal of the loan and paid up the interest they incurred in 2016. The financial expenses due to this loan interest were recorded on the income statement. Let's recall that collecting the principal does not involve any income because the company has to repay it in full, which means that the wealth of Copen has not increased because of that collection. Finally, the balance sheet reports that Copen has to repay the principal of the loan in the short term. As mentioned above, the transaction that we are analyzing throughout this unit refers to the purchase of machinery on April 1st, 2016. Firstly, as we did before, we identify the possible collections and payments that could have taken place in 2016 due to the purchase of that machine. In other words, we will determine the possible cash inflows or cash outflows related to this transaction in 2016. The wording states that this transaction is carried out on a cash basis. That's why when buying the machinery, Copen pays for the purchase price, 60,000 euros. Hence, we reflect the payment of the machine price on the cash flow table. Once again, it's good to stress that we show the intermediate calculations, even though they are also obvious in this case. As already mentioned before, it's a good way to strengthen the operating procedure that we are using to deal with this type of cases. We identify now the potential incomes and/or expenses accrued in 2016 regarding the purchase of the machine. We proceed as in the previous transaction. If the company's value increases, or in other words, if Copen's wealth increases due to the purchase of the machine, we will be able to state that this transaction generates incomes. On the other hand, if the company's value decreases, or in other words, if Copen's wealth decreases due to the purchase of the machine, we will be able to state that this transaction involves an expense. As has been said several times, it's important not to forget that within this context, company means the entire company shareholders unit. Well, we can say that the mere act of purchasing the machine does not involve incomes or expenses. That's to say, purchasing a machine does not increase or reduce the value of the company. This is because, as with the purchase of raw material, by purchasing a machine, Copen does not become richer or poorer. Copen has only acquired a good that is worth the same that the money they paid for it. However, an expense arises as time goes by. This expense is related to the fact that the machine loses value over time, and thus the company. However, this loss of value is not linked to the evolution of the machine market price. That's to say, to the possible second-hand price of the machine. In fact, this loss of value is connected to the fact that the machine gets exhausted over time. As time goes by, the machine loses service capacity. This loss of value, in short, an expense, is known as depreciation. The wording provides several data types that should be taken into account to calculate the depreciation expense that we should post in 2016. Firstly, the wording highlights the depreciation criterion to be used, straight line method. On that basis, the loss of value of the machine depends only on its age. The older the machine, the less value it has. Secondly, the lifespan, namely, the length of time for which the machine functions. And finally, the residual value, an estimation of how much it will be worth at the end of its lifespan. We can calculate now the amount of the annual depreciation. And now the following question can be raised. Can we post this amount as depreciation expense in 2016? Of course we can't, since Copen did not purchase the machine on January the 1st, but on April the 1st. The depreciation expense that we post in 2016 should be proportional to the length of time Copen has used the machine in 2016, namely 9 months. We reflect now the depreciation expense in the income statement. In this case, intermediate calculations are more meaningful. Finally, we analyze whether the purchase of the machine affects two other assets, other than cash, liabilities, or capital. Ultimately, we need to find out whether the purchase of the machine may lead to variations in the belongings, the rights, the liabilities, or the capital of company. Indeed, two different assets arise. Once Copen purchased the machine, it should be recorded as a new fixed asset. In accordance to the financial accounting principles, it's valued at its acquisition price. But we can't forget that the financial statements should accurately reflect the economic reality of a firm. Would it be true to say that at December 31st, 2016, Copen owns a machine worth 60,000 euros? The answer is no. Indeed, since the date Copen bought the machine to December 31st, the machine has lost value. The machine has lost service capacity. Depreciation measures such a loss of value. In particular, accumulated depreciation measures the loss of value of a fixed asset since it was acquired until a specific point in time, in this case, since April the 1st until December 31st. On the other hand, it's clear that this transaction does not involve any modification in capital since the shareholders neither contribute nor reduce capital. Let's record both assets on the balance sheet. Since the company was established on January 1st, 2016, the balances of all the line items on the 2016 opening balance sheet are zero. That's why the accumulated depreciation of the machine at December 31st, 2016 equals the depreciation expense in 2016. However, if Copen still owns the machine at December 31st, 2017, its accumulated depreciation at that date will amount to 10,500 euros. The accumulated depreciation at January 1st, 2017, that's to say, 4,500 euros, plus the depreciation expense in 2017, that's to say, 6,000 euros. One important remark regarding accumulated depreciation. That's an asset account that reduces the net value of the corresponding fixed asset. That's why accumulated depreciation is always negative. Let's summarize this unit. In this unit, we have posted the transaction related to the purchase of a machine on April 1st, 2016. Regarding cash flow, that's to say, collections and payments, in 2016, Copen paid up the purchase price of the machine. Regarding the income statement, that's to say, incomes and expenses, it's good to recall that the mere act of purchasing the machine does not involve any expense, since in exchange of money the company acquires a good of equal value. However, the machine gets exhausted over time, which should be reported through the depreciation expense in 2016. Lastly, this transaction involves two changes on the assets side, in addition to cash balance. On the one hand, the balance sheet now reports the machine at its purchase price. On the other hand, by means of the accumulated depreciation, the balance sheet reflects the loss of value of the machine since its acquisition date. In the next video, we analyze and post the transaction describing Copen's sales in 2016.